But in what may be a boon for airline stocks today, oil fell for the first time in 6 days. And the drop happens as well on a day that Bernanke had some upbeat comments about the U.S. economy. Airline stocks in focus as well, with earnings from Delta and Boeing coming out this week. Our next guest has one lone buy call in the airline industry, and it happens to be based here in Hong Kong. That's Cathay Pacific. Damon Horth is industrial analyst at UBS Securities Asia and joins us now in the Hong Kong studio. Good to have you with us, Damien, on a very inauspicious day as we're seeing a total solar eclipse, at least 3/4 of it happening here in the city. Why Cathay Pacific among all the airlines in the region?
I think Cathay Pacific's very well positioned. It has an extremely strong hub here in Hong Kong. That's a great position to serve mainland China. I think that's going to be a key driver of growth longer run. I also think that we're going to see a recovery in the cargo business over the course of the next 6 months. Cathay is very well positioned in the cargo market as well, particularly given its hub here. And I think the valuation is attractive. So I think you've got a reasonable business at an attractive valuation. So that's the reason for the positive view.
And it's a call that you've held on to since November. I see you on the Bloomberg. It's been a long time. I mean, we've seen the ups and downs. You stuck it out with Cathay Pacific.
I think the stocks recovered nicely. I think there's a bit more in it given we expect a cargo recovery, but the stock's getting close to my price target.
Okay, well, what about Singapore Airlines? You're neutral on Cathay's main rival in the region. How come?
Singapore Airlines is a very well-positioned airline. It's got a very strong balance sheet, great product. But actually, part of the product is part of the problem. To a certain degree, I think they've reconfigured their aircraft in a way which doesn't have enough seats on the aircraft. If you don't have enough seats on the aircraft, it pushes your costs up, and that forces you to put your prices up as well. So I think they may have a problem filling their aircraft profitably in what is still a very difficult economic environment for the airlines. So I've got some concerns about the configuration of the aircraft. They're not as exposed to the cargo market as Cathay, and I think cargo is coming back. So I have a preference for Cathay.
If you've got problems about airlines filling up passengers in the aircraft, why have a sell rating on AirAsia, a low-cost carrier? I mean, one would think that people are going to be traveling on the cheap, and it's going to fill the airline, that low-cost carrier, AirAsia.
Filling aircraft to a certain degree is easy. If you give the seats away, you can fill the aircraft. And AirAsia's not quite giving the seats away, but they've got very low.
They're not going to be in business, are they?
Well, the low-cost model is about using low fares to stimulate demand, and I think that's there. And longer run, I think the low-cost model's got a fantastic future in Asia. My concerns on AirAsia, basically, focus on the balance sheet. I think there's a lot of financial leverage there. They're looking to address that at the moment. So we'll see what the news is on that over the next couple of weeks. But again, come back to valuations. Airlines are generally bad businesses. Low-cost carriers can be the exception to that. So for an airline to be attractive for an investor, I think it has to come at an attractive valuation. And right now, I don't think the valuation of AirAsia is attractive.
Okay, last call. You got to sell on Air China at a time when a lot of the other brokerages out there are out there with a screaming buy. There doesn't seem to be any unanimity when it comes to Air China.
I think that's fair. I think I go back to my last point. I think for an airline to be attractive for an investor, it has to be cheap. Air China is not cheap. It's trading on something like 2 times book. I think consensus forecasts are too high. I don't think the consensus forecasts are fully reflecting the pricing environment in the domestic market right now. And that pricing environment is going to remain difficult in the second half, given that surcharges were so high last year. Domestic surcharges in China are now 0.
Okay, well, it's good to speak with you. Thank you so much for joining us. So buying Cathay Pacific and rest sell ratings. Thank you so much for joining us. Damon Horth of UBS here in the Hong Kong studio.